Hey there, I hope you're doing well. In today's video, we are going to dive deep into the business of Varun Beverages Ltd, which is the second largest PepsiCo franchisee outside of the US. The objective of today's video is to decipher if the recent correction in the stock price of Varun Beverages Ltd is an overreaction to Campa Cola's comeback in the market, or is it simply an unwarranted dip that presents an opportunity for retail investors to buy the stock at a discount. If you're new here, then hi, I'm Harshdeep Srivastav, a corporate finance graduate, an ex-investment banker, and now an entrepreneur. If you're really serious about building long-term sustainable wealth, then do consider subscribing to my channel. So without any further ado, let's get started. The beverage industry in India is broadly a duopoly wherein two players, that is Coca-Cola and PepsiCo, hold approximately 93% of the market share. But one brand has stirred up the entire beverage industry. Campa Cola, which was quite popular in 1970s and 1980s, has made a huge comeback after getting acquired by Reliance Retail. As we know, Reliance has really deep pockets. They're trying to disrupt the beverage industry with their Geo playbook. Not only are they offering 200 ml of Campa Cola bottles for ₹10, which is half the price of similar offerings by the competitors, but they've also set aside a capex budget of 6 to 8,000 crores, which will be used in the coming 12 to 15 months to set up 10 to 12 new greenfield manufacturing plants in India. Now there is one question that should come to your mind. Why is a beverage company trying to set up 10 to 12 different plants instead of 1 to 2 large plants? Well, it's because transporting these water-based beverages over long distances is not financially viable, and so if a company wants to succeed in the beverage industry, then it needs to have manufacturing locations that are close to the retail touchpoints. So all in all, this recent development has led to a correction of more than 25% in the share price of Varun Beverages Ltd, and now the stock sits at a critical juncture where it either stagnates just like the shares of Asian Paints stagnated after the entry of Birla Opus Paints, or it rebounds back within a few months by continuing to grow at the previous pace. Well, before we try to forecast what could be the possible outcome in the future, it's crucial that you understand the business of Varun Beverages first. See, Varun Beverages has a bottling and trademark license agreement in India with PepsiCo, under which it produces, markets and distributes a diverse range of PepsiCo products in India. It was in 1991 when Varun Beverages and PepsiCo came into partnership, and their association has stood the test of time. Recently, the bottling and trademark license agreement between them was renewed and extended till April 30, 2039, which is a great sign of business continuity, and at the same time it invokes trust among investors that this business is built with a vision to last. At the moment, VBL has 48 state-of-the-art manufacturing facilities and a robust supply chain that includes 130 depots, 2600 plus owned vehicles and 2800 plus primary distributors. It derives 72% of the revenue from India business and 28% of the revenue from international business. Internationally, VBL has established a strong presence in the South African market by acquiring Bevco, a company that has 75 plus years of experience in the soft drinks market, and it has also recently acquired SBC Tanzania and SBC Ghana, both PepsiCo bottlers, for a sum of 1431 crores to further strengthen its hold in key African regions. Now, since VBL already has a strong distribution muscle, it is targeting to diversify its product portfolio by doing strategic partnerships with snack brands. For example, VBL has partnered with PepsiCo to sell Lay's, Doritos and Cheetos in Morocco and Kurkure Puffcorn in India. It has also signed an exclusive snacks franchisee agreement with Simba Munchies to sell in Zimbabwe and Zambia. I'm quite certain that if VBL keeps on following their inorganic and organic growth strategy to capitalize on their existing distribution muscle, their revenues will keep on growing in the long term. Now let me share with you 5 useful insights that have made me bullish on Varun Beverages Ltd. See, first of all, there are more than 12 million retail outlets in India, and VBL is only present in 4 million retail outlets. This means the industry is still significantly underpenetrated and there is enough room for everyone to grow in the market. The chairman of VBL, Mr. Ravi Jaipuria, says that the entry of new players, especially players with deep pockets like Campa Cola, is only going to aid in growing the industry faster. At the moment, VBL has put 10,20,000 chilling equipment, that is Visi coolers, at retail touchpoints, and the company is strongly opinionated that increasing this number consistently will keep fostering the demand for VBL's product line. For this, they are also buying 50% stake in Everest Industrial Lanka, which specializes in production, manufacturing and distribution of commercial Visi coolers. Secondly, since water-based beverages can't be transported long distances, the manufacturing plants need to be in close proximity to demand. Since disposable income is increasing across both urban and rural areas, the company is solidifying its supply chain for efficient distribution in both the demand areas. VBL is strengthening the last mile distribution networks and launching localized marketing campaigns to drive deeper penetration and to simultaneously unlock new growth avenues in rural and remote areas as well. Thirdly, as we all know, no company survives in the long term if they don't change their offerings in tandem with the changing consumer preferences. The thing with Varun Beverages Ltd is that it has kept pace with the health trends that are driving demand for low sugar, zero calorie and functional beverages with vitamins and probiotics. It has adapted by cutting back on sugar with products like Gatorade Zero, 7up Zero, Pepsi Black, etc. By introducing these products in India, VBL is ensuring that it still has products to offer to customers who are transitioning towards healthier alternatives. Fourthly, beverage manufacturing business requires cold storage infrastructure such as large cold rooms, insulated storage areas, refrigerated trucks, etc. The cold storage infrastructure helps to keep large volumes of beverages chilled for days and weeks before they are dispatched to retailers. This is necessary to maintain product quality before distribution. VBL has enhanced cold storage infrastructure that enables it to better serve consumer demand in rural and remote areas. Last but not the least, with the increasing competition from new age brands, it's of utmost importance to protect the margins to be sustainable in the long term. VBL knows the importance of cheaper raw material and so it has a centralized sourcing team for cost efficiency. Moreover, VBL has a strong focus on backward integration as well. VBL recently made a 200 crore acquisition of Lunar Mech Technologies, which is in the business of manufacturing plastic closures. The backward integration facilities of VBL are involved in the production of preforms, crowns, plastic closures, corrugated boxes, corrugated pads, plastic crates, and shrink wrap films. This not only helps to ensure operational efficiency, but also helps to maintain high quality standards. From a financial point of view also, VBL has had 22.9% CAGR growth in revenue in the last 6 years and 41% CAGR growth in profit after tax in the same period. They've also reached 7,500 crores through qualified institutional placement recently, which will further aid them in continued growth. In terms of volume also, the company witnessed a CAGR of 17.9% in the last 6 years. Despite the heightened activity in the industry because of Campa Cola's entry, VBL does not anticipate a major squeeze on margins, and in fact, in Q1 of 2025, EBITDA margins actually grew by 111 basis points in India. Now definitely, Campa Cola may also start making a mark in the industry because of its affordability, but I believe that PepsiCo and Coca-Cola are both cash-rich companies and so they will give a good fight as well. They've already started doing it by launching affordable SKUs in the market. While these new SKUs may hit the margins a little and the cola pricing war may persist in the medium term, in the long run, VBL will continue to be a major market shareholder in the beverage industry. The thing with established companies like PepsiCo, HUL, P&G, etc. is that these companies are legacy companies, and if a retailer doesn't keep their products, then he's most likely going to lose a lot of customers. This is the reason even if Campa Cola offers better margins to retailers, the brands of legacy companies will still be present in the last leg of retail touchpoints. I personally have invested more than 3% of my portfolio in VBL and I'm already up 12%. After reading the book Richer, Wiser, Happier by William Green, I'm more confident on investing in companies like VBL. Why? Because the book clearly mentions to invest in companies that are built to last and buy good companies at fair valuations instead of buying average companies at deep discounts. Now keep in mind that this video is not at all an investment recommendation, and so you should do your own research and consult with a financial advisor before making any investment decision. My objective through this video is only to give you a direction about how you should go about analyzing beverage-based companies. Let me know in the comment section what are your thoughts on a stock like VBL. Do you think VBL will lose its charm after all of Campa Cola's new greenfield facilities will become operational by FY27? Or will VBL continue to grow by focusing on under-penetrated regions? Thank you so much for watching till the end. Like the video, hit that subscribe button and stay tuned for my next video.